Investors are happy.
Yeah.
They are here. What are you observing in the markets? Are they, when you look at, we still tout on the fact that we have a lot of foreign dominated, participation. Are we still seeing the same? Is there an influx? Are they getting returns? What's the state?
Actually, there are interesting developments in the equities market this year. For one, we noticed turnovers are up strong double digits.
Okay.
We're now doing 75 billion equities turnover in the first 11 months of this year. Looking at the participation mix, for the first time in 5 years, you're starting to see a rise in foreign participation after a 5-year consecutive decline.
Wow.
So as of November this year, we had a foreign participation rate of 56%, up from 49% last year. So looking also at market valuations, if you look at industry price to earnings ratios, they're generally coming up. The market PE is coming up, meaning that investors are pricing in high expectations of improved corporate performance next year. So as a result, they're willing to pay more for a shilling of earnings per share, because the higher earnings per share are associated now with higher dividend payouts and higher capital gains as a result. Looking also at the direction of flows, foreigners have now trimmed down on their net exit activity that we've been seeing over the past 5 years or so. So we're seeing a brake pedal being put on flows. So we are starting now to see some months recording net inflows, which is a very good sign. And I think it was very much in expectation now that interest rates are starting to come down in the fixed income market, both in developed and developing economies. So that has compelled investors to, divest back into equities, and that's what we're seeing at the moment.
Lovely. All right, Stella. As we come to a conclusion of this, I want you to bring us closer to some of the environment, the operating environment we've had, and this year definitely has gone notably on a lot of taxation and policy changes that we have seen. And I don't know from the ground, because you're communicating with the people a lot, from the finance acts that we had to really introduce and the impact of what we've seen with the new tax measures. What are you observing in general?
I'll comment on the private sector business environment.
Excellent, yes.
Which is heavy on input costs and largely depends on how this turns out. So there has been an increase in input costs back from 2023 when we had the Finance Act 2023, which also had an increase in many key things. And I mentioned earlier about the VAT on fuel. So remember, most sectors, for example, in the manufacturing sector or even the economy at large, depend on fuel as an input. So when you look at that, and then you look at electricity, so electricity prices also have a fuel charge on them. So when we have an increase in fuel prices because of the taxes, then it will also translate to higher electricity prices. So we've had a very difficult issue with input costs in the private sector, which has then made output prices higher. So this means that again, we will have less demand from the buyers or consumers of these particular services and goods, which means that there will be constrained margins, which has again been a highlight of the year, with lower margins for businesses, which has also curtailed expansion and investment into new areas or new products.
I was looking at the markets. Normally we end the show with markets, but we just discuss it here. Through the year to date, top gainers we had East Africa Portland, Orchards, Kenya Power, I&M Holdings, and KCB, which we know definitely is quite significant, but I want you to just make a comment on them. Especially looking at some of them, we had highs of 297%. And 79% to 297% within those five, which is quite significant. Any comment on any of the sectors that you've seen there?
Yeah, for sure. As I spoke on earlier, some counters have recorded triple-digit returns this year, led by East African Portland Cement, which, as you know, was in the context of the industry, which is the construction sector, we had a buyout taking place on one of its rivals, which is Bamburi. And when you look at the book value of East African Portland Cement, relative to the market valuation, it was trading as low as less than 10% of the book value at some point. So the appreciation in its price could be interpreted as a correction. Or gravitation back to the industry average price to book valuation. So yes, that was a significantly undervalued stock. Fortunately, this year we've seen a turnaround to profitability on the counter, which again has further solidified its new valuation, as it were.
One of the interesting observations is coming from what Stella has just mentioned, that we are seeing reductions on imports. And it's because of people in their pockets really being strained. And then we come here, we are looking at the construction industry and we're looking at the stock here, and it's doing super well. It looks like it's a mixed bag here. So it's really not easy to just point out some of these factors. But comment on the losers as well. I see the media industry has been touched a lot from Nation Media. I also see Kenya Re, I can see Standard Group, Sasini Sanlam. I don't really have a comment on it because you're also on the reds there through the year.
By and large, with Nation Media Group, they've just concluded their buyback. Which we were yet to get the official results. However, in the context of other competitive performing stocks, the opportunity cost of holding your money in Nation Media was way higher compared to, even T-bills would give you better returns compared to what Nation, because they've not been paying dividends. And right now there's low investor tolerance for counters that are loss making or not paying dividends at all.
You'd rather go to
you'd even rather just do fixed income. But right now, all things considered, I think the stock market is well poised for a decent recovery next year.
Stella, fixed incomes, the bonds, what are we observing? Because I know rates are going down. We are not happy, but go ahead.
Rates are going down and swiftly, to say the least. So I think we are looking at single digits, especially for the treasury bills by the end of the year. So
and they recorded very high, to as high as 17 there.
At some point. So investors who locked in the rates are the lucky ones. But going forward, the rates will go back to where fixed income investment asset classes are slightly supposed to be, so to say. So the outlook in terms of fixed income, I feel like investors will go on divesting to the equity side because equities will have better returns compared to the single digits in the fixed income environment.
Which is good news for Ronnie.
Yes.
And the market. Absolutely. I want to close by asking you guys to give you a parting shot. And the parting shot will be just outlook as well, 2025. What are you expecting? What are your random thoughts? I don't know who's going to start. Stella, you ready?
Go ahead. Yes. So in terms of the outlook in 2025, I'll look at it from two sides, the fiscal space and the monetary space. So on the fiscal space, we are looking at the expenditure, revenues, credit score, and public debt. So all that concerns that. So we are looking at, my expectation is that the government, for example, will not meet their revenue targets in the current fiscal year, which ends in June 2024, because of the business environment, again, that I've been talking about.
2025 now.
Yes. So, So, and then we are looking at even higher revenue collections in the next fiscal year, again, which starts in June 2025. So the finance bill in 2025, again, is expected to be a bit aggressive, so to say. But I believe that the approach will be different this time round, because we've had the National Treasury say that there will be more communication, more transparency, and more public participation engagements. So I expect that from that end. In the monetary space, I expect rates to continue going down, the central bank rate, maybe to close at 8%. I'm optimistic with 2025, 8 or 7%.
Yeah.
So this means that credit will be more affordable compared to where we are right now.
Okay.
And there will be less crowding out because, as we've seen, the government securities rates are going down. So I expect capital to be more, money will be released into the private sector.
Yeah.
And with this, we will see more expansion and more thriving and lively business environment.
Thanks for that, Ronnie. You have a partnership. 2025, yes.
My outlook on 2025 is rather bright.
Okay.
Yeah, I think we are out of the storms after a 5-year, stagnation period.
Okay.
Inflation has moderated, meaning prices are stable. This is good for both businesses and consumers. For businesses, it means predictable costs.
Yeah.
Good for planning. For consumers, it means once prices are predictable, they're able to plan and consume on based on predictable price patterns. This should reasonably support positive earnings outlook for most of our listed entities. So by and large, I expect improved corporate performance next year across majority of the sectors that are not exposed to external risks. Secondly, looking at the equities market flows, I expect an influx of dollars next year.
Yeah.
And now that fixed income returns are coming down in developed markets, foreign investors are encouraged to diversify back into emerging and frontiers, such as where we sit.
Yeah.
So that should really propel valuations on our counters next year. Yeah.
Wow. My goodness, thank you so much, Ronnie. Thank you so much, Stella, for your sentiments. And of course, to our viewers, thank you so much for really watching, and I hope you have a better view of how the year was, and of course, from the sentiments of their outlook 2025. And we really hope, from the words of Ronnie and Stella, it's going to be a great year. Thank you so much for your time. Merry Christmas and happy 2025. Of course, keep it locked here on the Trading Bell. We have great and much more.